Introduction to Debits and Credits in Accounting. Brief overview of debits and credits in accounting. Luca Pacioli, a famous mathematician during the year 1494, founded the double-entry bookkeeping, and as a result the concept of debit and credit came about. We will see what is the double-entry system and the balancing principle. Debits and credits concept. Accounting equation. Assets plus expenses equals equity plus liabilities plus income. Debits. It represent increases in assets or expenses, or decreases in liabilities, equity or income. Credits. Represent decreases in assets or expenses, or increases in liabilities, equity or income. When inserting to AT accounts, it denotes debits on the left-hand side and credits on the right-hand side. Now we will see some examples. Take a scenario of purchasing something on cash basis. Transaction. Business purchases inventory for cash. We will see how it works in accounting terms. When inventory is purchased, it increases the company's assets, inventory, and in the same time decreases its assets, cash. Increase in inventory account, debit. Decrease in cash account, credit. We will take another example. Purchase of office supplies for cash. Office supplies, an expense, debit entry, and cash, an asset, credit entry. Now we will take an example of a loan repayment. Transaction. Business repays a loan. Pay attention on how it works. Loan repayment decreases the company's liabilities, loan payable, and decreases its assets, cash. Decrease in an assets account, cash, a credit entry. Decrease in a loan payable account, a liability, a debit entry. Additional example. Now we will see a scenario of a settlement to a trade creditor. Trade credit, a liability, it decreases, a debit entry, and cash, an asset, it decreases, a credit entry. Now we will see how a sales revenue, an income, being recognized in accounting terms. Transaction. Business makes a sale on credit terms. Pay attention to how a company revenue being recognized in an accounting terms. Sales on credit terms, it increases the company's assets, accounts receivable, and increases its income, revenue. Increase in an accounts receivable, an asset, a debit entry. Increase in a revenue item, an income, a credit entry. We'll take another example, this time, a sales of goods on cash basis to a customer. Cash receipt. Increase in an asset, a debit entry, and a revenue, increase in an income, a credit entry. Now we will take an example of an investment of a machine by a promoter, owner, to the company. Increase of a machine, an asset, a debit entry, and increase in capital or owner's equity, a credit entry. Balancing principle. The total debits must equal to the total credits to ensure accurate accounting records. When all the accounting entries enters correctly, we can check it through the trial balance. The trial balance is a summary of all the debit and credit balances in the ledger accounts of a business. It is important that the trial balance is balanced for accurate financial reporting. Common mistakes and corrections. There are few common errors such as omitting entries, recording transactions incorrectly, or failing to balance accounts. Corrections of those mistakes can be done using a suspense account. Ultimately, the trial balance should be balanced. Importance of debits and credits. In summary, the double-entry bookkeeping using debits and credit help entities in accurate recording of financial transactions, maintaining the integrity of accounting records, preparation of reliable financial statements. More practical examples using numbers in a real-life business world. Revenue recognition. Transaction. The business makes a sale of $1,000 worth of products to a customer on a credit basis. Recording the transaction in the books. Sales on credit will increase, accounts receivable, an asset in the balance sheet. Increase in assets as the business expects to receive the payment in the future. A debit entry needs to be raised for $1,000 in the accounts receivables account. In the same time, increase in revenue from the sale, a credit entry of $1,000 needs to be raised to the revenue account in the income statement. Impact on financial statements. Income statement. Sales revenue increases by $1,000, reflecting the revenue earned from the sale. Balance sheet. Accounts receivable increases by $1,000, representing the amount owed by the customer. Expense recognition. Transaction. The business pays $500 for office supplies. Recording the transaction. Increase in office supplies expense, a debit entry to the office supplies expense account. Increase in expenses as the supplies are consumed, and this will reflect in the income statement. Decrease in cash, a credit entry needs to be raised to the cash account, and this a decrease in assets as cash is paid for the supplies. Impact on financial statements. Office supplies expense account, a debit entry of $500 needs to be raised, reflecting the cost of supplies used. This will reflect in the income statement. In the same time, in the cash account, a credit entry of $500 needs to be raised as cash decreases by the same amount. This is a reflection of the cash payment made to the supplies. This will reflect in the balance sheet. Asset purchase. Transaction. The business purchases equipment for $5,000, paying cash. Recording the transaction in the books. Equipment increases by $5,000, a debit entry needs to be raised in the equipment account as it increases, and this will reflect in the balance sheet. Cash decreases by $5,000 as for the payment for the equipment, and this will again reflect in the balance sheet by a credit entry to the cash account. Impact on financial statements. Balance sheet. Equipment account increases by $5,000, reflecting the value of the equipment owned by the business. Cash account decreases by $5,000, representing the cash payment made for the equipment. Incurring a new liability to the business. Transaction. The business borrows $10,000 from a bank. Recording the transaction. Cash increases by $10,000 as cash received from the loan. A debit entry needs to be raised as increase in assets as the business receives cash. Loan payable account will increase by $10,000, and a credit entry needs to be raised as liabilities increased owing to the business incurs a loan obligation. Impact on financial statements. Balance sheet. Cash increases, asset, by $10,000, representing the cash received from the loan. Again in the balance sheet, loan payable, a liability, will increases by $10,000, representing the amount owed to the bank. Conclusion. These examples demonstrate how debits and credits are used to record transactions and their impact on both the income statement and the balance sheet. Debits and credits ensure that every transaction is accurately recorded, maintaining the balance of the accounting equation. Assets plus expenses equals liabilities plus equity plus income. Understanding these principles is essential for effective financial management and reporting in business. If you feel this video helps you in understanding the concept of debits and credits, do like the video and subscribe to the channel for more similar content. Thank you for watching and see you in the next video.